interesting year when you think about how it started, obviously with the euphoria around Trump, causing markets certainly in the back end of last year to certainly sell off on the bond side of things, yields pushing higher. But this year it's been a little more challenged because clearly that euphoria quickly dissipated, obviously harder to get through policy. And then of course you've seen some other challenges obviously with North Korea. Since then though, there's been some real positives when you look at some of the risks around China dissipating, obviously seen good growth in Europe, following through in Japan as well. And I think generally the globe's feeling better about those risks. But the point is that clearly inflation is still on the lower side. So despite the fact that you've seen these improvements in unemployment in the US, obviously unemployment pushing back to sort of 17-year lows, you're still not seeing that wage side increasing significantly, and therefore with inflation low, central banks are yes moving in some places, but generally we're not expecting any change from the RBA, for example, certainly through this year and into next. And so therefore bond markets are sort of relatively stable. Funds actually performed rather strongly, certainly in terms of outright returns, over 2.5%, so much better than cash. Relative to the benchmark, we've outperformed in line with our objectives, which is above 75 basis points. So that's really pleasing, and done so with volatility lower than the benchmark, which is also objective as ours. So overall, very happy. This outperformance has actually come from a broad number of sectors and strategies. Firstly, certainly duration's been positioned slightly shorter than the benchmark, so that's certainly contributed as we have seen yields marginally higher over the year. Also, we've liked the long bond, in fact, relative to 10-year part of the curve, so 30-year versus 10 has contracted as we thought it would, and that's added. And sector-wise, we've certainly had an overweight to supranationals. That's worked for us, as well as an overweight to credit, which has certainly been a strong contributor, as certainly the setup for credit has been supportive from a fundamental and also from a technical basis. So it's been pleasing to be able to add value in all those components. Certainly, I think the RBA is constantly in question by the market because we have seen movement by other central banks offshore. But from our perspective, clearly the RBA is on hold. They need to be. The consumer's indebted. They're certainly constrained on that front. Obviously, energy prices rising, so it's constrained in terms of consumption as well. And so I think it's very difficult for the RBA to actually move rates, and therefore, as a result, bond yields are going to be relatively constrained by that short end being captured by the RBA. So we think that our strategy will continue to work. Certainly our positioning in terms of interest rates should work, and certainly our overweight to credit is likely to continue to perform because the fundamental and technical backdrop there is still supportive. So overall, we think we're going to see a continued outperformance, which is pleasing.